when I take a look at my inbox and I see that I have many questions sort of revolving around a typical topic, a singular topic, what I want to do is address it with you guys and talk about, well, yesterday's sell-off and even a bit of today's sell-off. And so I'll say this, as the market's been moving higher, clearly we know that the overall move higher has in many ways been flirting with going parabolic in individual indices and sectors and individual stocks. And, some people will call it overbought. I don't believe there's such a thing as overbought or oversold in a trend. I believe that's jargon for sideways markets. And it's also true and applicable in sideways markets, but not in trends. Trends are by their very nature imbalanced. So when we get a day like yesterday that happened, and there's some kind of, you're supposed to know, like someone got the memo that the day was going to be a much more dramatic sell-off. Now, first of all, let's measure drama. When I say much more dramatic sell-off, what we're doing is we're going to the range movement, the price movement range for the day. So on a Thursday, the price movement range on average is 85 for the S&P and 110 on the upper end. That's a 68% probability for what we see, average to high. All right. So then I look at the high to low range, and then we see that right there, you can see the high to low range. We blew that number away and then some. So as soon as we exceed the average to high of the price movement range, that's the measuring stick by which we say this is the typical high-low range probability for a market. Once we exceed that, we're outside what we can now sort of have a measuring stick for, which is what we're outside of normal. The other thing that I want to mention is that the pattern that we saw really was in many ways kind of an aggressive take at a minor high. So you have this lower high right here, you have the high, and then you're surrounded by another lower high. Once you take out the support of either what we would call candle 2 or even candle 1, and you can check this out. I have the explainer for minor highs and lows, but let me just tell you guys what it is. It's a really simple little pattern. Minor high, minor low. So the idea here is to have a lower low or a higher high, either surrounded by 2 higher lows or 2 lower highs. And that's all that it is. When we take out the low, there's a certain bearishness that you can say is associated with the move. Now, when you take a look at the volume levels, when you start taking a look at our V profile and the volume levels, you'll notice, wow, we took out the value area high. Now, where is this anchored? That's another question to ask. Where is that anchored? So, clearly in our different classes using volume profile, we've talked about different ways to anchor these, but this could be considered your September anchor right here. So far, since the end of August, that's been the point of control. And we just absolutely smashed that yesterday. So add to that high range, abnormally high range, breaking the point of control support. Yeah, there's a lot of things folks will say about breaking support, but I don't believe in any way it insinuates that we're going to see a much larger move. And the same thing happened in the NASDAQ. Okay, so this isn't just a singular, well-chosen example. Same idea, same tools, same pattern, same level broken. So again, if I take a look at the range of the NASDAQ, 780 points yesterday, typical price movement range for a Thursday, heck, for any day, right? Let's forget the Thursday. Thursday, it's 300 to about 360. Let's use the upper end of almost 400 points. That's upper end, right? Once I exceed these highs, we're outside the norm. 780 points, where I know after about 360 to 400 of those points, we're in a completely different kind of market volatility environment. We break the point of control. We exceed that 360 to 400. Again, this is where in the morning, and look, all my cards on the table, and you guys will know because I make my setups pretty open as far as what I'm looking at in the first 2 hours that I like to trade. I had a great Monday. I had a great Tuesday. We had a great Tuesday in the room. Pretty solid Wednesday. Not a lot happened on Wednesday, but Tuesday was good. And then Thursday. The Thursday we have this. Are we sitting through all of this? No, of course not. Once our validity is broken, once we start exceeding levels like this, once we start breaking down through our clearing range lows, once we start realizing V-score lows aren't going to hold and value area lows aren't going to hold, and all those different things that we will measure the morning's action by, we're done. We're done. So I think that for a lot of traders, they look back on Thursday and it was jarring. And they might even look at today too. But today was a caution day. Why? Non-farm payroll. Not to mention, when you get a day like this, are you looking for suddenly normal action the day after? Especially going into a long holiday weekend, a 3-day weekend? Of course not. Right? Of course not. So I hope this sort of gives everyone some perspective. Kind of, I want everyone to sort of get their legs back underneath them, prepare for next week. We have a short week, but it really is the beginning of the fall trading season. And I'm stoked. Let's get this out of the way. In yesterday's video, I really emphasized these are going to be buying opportunities in the markets that have double green. And I'm not changing that whatsoever. In fact, if anything, I just want to make sure that after 2 days of a sell-off, we're still looking at double green in certain indices, sectors, and stocks. And those will be my focus going into next week. All right, gang, does that sort of help out, right? That's what I want you guys to have, some kind of psychological stability after 2 crazy days, just kind of accept it for what it is. It's a correction. It's one that happened pretty swiftly, and then we're just going to carry on.